Hey guys, Freaky Finance here. Last week we looked at PayPal, and this week we're going to look at Kohls. Kohls is an interesting company. I would say it's your standard retailer. We've talked about retailers in the past, but they've recently sold back down pretty much since August 1st. They rallied crazy in July and they've come back down since. Still up quite a bit, so they're starting to get exciting, so I kind of want to get this video out ahead of time as I expect them to keep selling off. So anyway, let's get into it. I'll just show that I do own this one as well. So I've been in Kohls a few times. I've read it up a few times from 20 and 22. So I have it in two different accounts, both times right around under 23 bucks. And I've picked up a few over. They're all still very cheap relative to what they used to be. They're all relatively cheap for the same reasons, so it's affecting the same industry at the same time. But Kohls has a couple interesting avenues. We'll talk about Sephora and we'll talk about the property value backstop. Those are the two main unique things to Kohls. But a lot of the retailers, we've kind of talked about how during COVID, sales shifted to goods because of lockdowns. So all the spending went to goods. And so we had basically every company that was a retailer was selling all their inventory with no promotions needed, so high margins. And then in order to get more inventory to replenish, they had to all order. And they all had to order at the same time, and that increased freight. A lot of these guys were sourcing from China and Asia. And so you had this big freight increase. At the same time, you had inventory start building up because the consumers stopped showing up because the consumers started switching from goods back to services because things reopened. So you had this huge inventory build, while at the same time you had freight costs high. And so as they had to push out this inventory, they had to discount it to move it in time, or else your inventory still becomes obsolete, especially in fashion and apparel. That's happened for the entire industry. And so we're still going through that. And a lot of companies have finally, this wasn't the case 6 months ago, but it's the case now, that they finally have the inventory below what it was last year. And some of them are up. Their inventory is 20% better, 10% better. In Kohls' case, it's 14% better than it was last year. So they've chewed through their inventory overhang, but it did depress the margins. And so we're going to go through that now and see, are we approaching a bottom? There could still be some time. I'm going to go through it, like I think between now and the end of the year. I'm hoping for that last big sell-off panic because we are seeing things still slow down relatively. Let's just talk about the business first. It kind of sets the stage. So one of the other themes in retailers is that national brands and private brands, so private label, has generally been taking share from national brands over time from a retailer perspective. Think the best example of this would be Walmart with Great Value. They slowly continue to take share from, say, the Kraft Heinz of the world or Pepsi. Well, Pepsi might be a bad example because they have a pretty strong brand. But our General Mills or stuff like that, they've basically been able to take share from that over time. And that's also true for Kohls. Obviously, different example here. So they'll have their own Kohls type brands, and then they'll have their national brands, which would be like your Nikes or Under Armours and stuff like that. Anyway, you can see that the spread is pretty good. It skews slightly to women, but also fairly well to men and children and home. So fairly diversified, I'd say. We have seen accessories continue to slowly increase, and that's also improved ever since Sephora. And we'll talk about Sephora as well in a bit. It's one of the reasons why this company actually might be better than other companies. If they're the same price, you would say this one might be better because of the Sephora investments they've made. Here is an interesting one. So this is just the revenue breakdown over time. It's not a confusing business model. Most people know what a retailer is for, your average department store. Most people walked in once. I don't really need to explain too much, but they do have a different type of revenue as well called other revenue. And that's your credit cards. And a lot of the department stores have their own credit cards now. They partnered with a credit card company. So in Kohls' case, it's, I believe it's Capital One. Yeah, Capital One right there. And you can see as a percentage of the business, it's actually pretty high. So 940 million in 2022, and they only had 17 million in total sales, or 17 billion rather in total sales. So a decent amount of it anyway is credit card focused. So they do make quite a bit of money off their credit card lending. And we see Macy's just get into a little bit of trouble with that. So that is a headwind at the very end of the cycle. Usually credit lending gets cut off, right? So that could be the last leg to drop here. But I wanted to bring that up because it's just kind of an interesting thing to keep in your back of mind that some people don't think of when they think of department stores. They don't actually realize how much the company-specific credit card actually torques for the business, how much benefit it does for that business. Here is just, they're talking about the credit card could adversely affect our sales. It's just, if you want to pause and read it really quick, it's just one of the things you gotta be aware of when you own Kohls or say a Nordstrom or a Macy's. They'll have their own specific cards. In terms of sourcing, the majority of goods are sourced, manufactured outside the U.S., primarily in Asia. That was as of the last 10K, so it's still fairly recent. So they're obviously still making quite a bit over there. They don't name a country. They do third-party purchasing for 20% of the merchandise. So I just thought that was worth bringing up so you can help visualize Kohls as a business. One of the cool things with Kohls, though, is this, so the property ownership. So they do have 1,170 stores. Well, that store number we'll keep in the back of our head because that's important for Sephora's build-up that we'll talk about. But you can see that overall, it's fairly spread out, pretty much indexed with population. So they have the most stores in California, second most in Texas, right? And they have Florida, and they have a decent amount in Illinois, actually, Pennsylvania, New York. So they're all over the place, all over the U.S. Importantly, though, so you can see here owned 409, leased 518. So they owned 409 stores. So of the 1170, they do own a decent amount, and this would be the ability for them to sales lease back. They also own quite a bit of their distribution centers. The red ones are ones that I X'd out because those are the ones they don't own. So they own quite a lot of their distribution centers as well. And we've seen a trend, especially in the smaller cap names, where they've done sales lease back to buy back more shares of the company. Now this company still hasn't done that, and they've already bought back a large amount of the company over the last decade. And we'll talk about that as well for Kohls. It's one of the catalysts over time for value. We'll talk about, this is funds that tried to do a takeover of Kohls back not too long ago, actually. I think it was in 2022. But anyway, that's them trying to value properties, and they're basically saying, we estimate the properties to be worth $7.5 billion. They're basically saying you'd be an idiot not to sales leaseback because you could sales leaseback at a value of 14 to 15 times EBITDA and buy back your share price where your multiple in 2019 was only 4.8. Right now we're sitting at like around a 2 or a 2.5. Very, very cheap. Now it's cheaper because the operations are currently still depressed from the COVID hangovers, as well as a relatively weak consumer for goods. But longer term, it's definitely a value here in property land, if you believe in this. Even half this would be amazing for this company if they were to actually do that. But they resisted that last time. They also resisted the takeover bid using a poison pill, which we'll talk about as well in a bit. But I thought that was worth bringing up because it is fairly unique for Kohls. They have a lot of land value, property value. So Sephora is interesting. I already talked about how they have inventory under control. We'll look at that as well on the financials real quick. In this quarter, they opened 200 stores, or Sephora stores rather. So that's important because they only have 1,170, right? So they just did 200 this quarter, which is very impressive. And so we are seeing the Sephora build out very quickly, and it keeps putting up results for them. So I like that. I like how aggressive they're pushing it. They haven't let the decline in current operations affect their push out in the Sephora. So I like that strategy in the long run. This is just a look at Kohls plus Sephora. So they are really pushing Sephora because it is such a generator for them. And what I mean by that, sales up 20% year over year in same store. Very, very strong. I talked about that, the 200 this quarter alone. And one of the things when you open up the stores, you have to hire people ahead of time. So we also saw SG&A increase in the quarter ahead of when they actually get to recognize more of the sales from actually having the store open for longer. So this is also very exciting, especially because we saw inventory go down. So not only were they able to get more of these Sephora products in there that are higher ticket items, but they're also able to still reduce inventory year over year, which is important. So I like this. And again, like I said, they only have 1,170 stores. So by the end of this year, they're going to be done 900 of their 1,170 stores in this partnership. And one of the things they're doing with this partnership, just strategically, is that they haven't really been able to target younger demographics for a while, right? Really, the average person that goes to Kohls probably, historically wise, would be older than me, myself. Whereas someone that would shop at Sephora would probably be younger than me. What I'm trying to say there is that they're targeting a new demographic. And at the same time, they're able to cross-sell. We'll go through the call, but they basically say about 40 to 50% of people will buy something else once they shop at Sephora in their Kohls. So basically, they're able to cross-sell their Kohls products with the Sephora offering. And that's very exciting because Kohls has been a same-store sales decliner for forever. So if they can actually stop that, even just flatline it for a bit, this company's price, like it's not even going to be here in 5 years based on this price. So it's very exciting. Anyway, that's what I'm trying to say. And it is unique to these guys, and they've already, peak investment was already last year, so we're not even at the peak investment year. CapEx is actually down year over year now. and it will continue to be now that they've already done 900 of their, 850 of their 1170. They'll be done 900 by the end of this year. So anyway, I thought that was interesting. Here's the capex. As you can see, it shoot up. So this is the Sephora build out right here, the store strategies. You can see the capex spend just shoot up. We're finally seeing it cap out this year. Last year, 826 in capex, and this year they're pretty much getting to 650 million. So still high, but not as high. We're going to see that decline as we go. All right. Hopefully that makes sense, helps us to stage. And are things good for them right now? No. So operating margin only 4%. Normally they do 6 to 8, and their sales are still guiding down, be down year over year. And for the record, 2022 wasn't good for these guys either. So now they've had 2 years now of sales declines. EPS is also guided to be pretty weak, 210 to 270. So expectations are pretty low. They normally put up $4 to $5 earnings power. They've already taken down expectations quite a bit because the performance hasn't been there, because not that much spending is going on in goods land still. And here's they're basically saying what they think they'll get back to 7 and 8% operating margin, which is technically a double in earnings power from what they're currently doing this year. So one of the reasons why it's cheap is because the underlying operations has been in decline. And we can see that just on the latest quarter. Let's blow this up real quick, but you can see that you can still have digital sales down 17% year over year. There are 25% of sales now is online, which is still okay, but I mean, you're still down year over year. Same stores are actually flat, which is interesting. What else is there? COGS was kind of mixed, so we're selling less, so it should have went down more. It actually went down in line. Part of that is because they have less freight this year, which is a good thing. And that should be a trend in the future, but they also have a higher product cost for inflation as well as shrink still on this line. So from less sales and COGS just going down in line with sales, you're pretty much down 100 million in GMD, and that really floated to the bottom line. You can see that even net income was actually pretty clean. There's actually an operating income too, pretty clean, down 100 million. Earnings quality wise, it's pretty nice and simple. There's no magic going on in these financials. Inventory is down 13.8% year over year, so that's important. That frees up a lot of the working capital for the Sephora build out. It's one of the reasons why I think they're able to push as much as they did this quarter. 200, like I said, 200 stores isn't small for these guys in a single quarter. So I think this is exciting because they're finally past the peak capex build out for Sephora, and they'll finally be able to harvest some of the returns on that, those investments they've made. Did it come at a cost? Yeah. So you have the revolver here being used. So it's up 560 million year over year. It was at 700 million this last quarter, so they are starting to pay it down again with the working capital free up from less inventory. Anyway, you can see that the I should bring up here that they are planning to get their revolver back down, so the year over year debt should go back in line by the end of this calendar year, or end of January. I think they have January year end. Retails like that. All right, else is worth bringing up. They're still free cash flow negative, so that's one of the reasons why the balance sheet's taking it on the chin. The cash has to come from somewhere, so it's coming from the revolver. That also needs to in order to pay the dividend. They were buying back a lot of their shares, but they stopped as the economy got worse for these guys, and less consumer demand, which I view as prudent, especially as all the cash flow was going to the Sephora build out. What else is there? We already talked about operating income down 100 million, so that's important. So while the share price is down, like if we look the equity EV, you're down. You're getting the 62% off sale from year over year, which is nice. But again, part of that is the operating income is down about 40% year over year, right? So while it's 60% cheaper, it's 40% because of weaker fundamentals year over year. So basically the market's I'd say one, it's overreacting to a slowdown potentially at this price, and it's also extrapolating the current slowdown into the future in perpetuity. So longer term, Kohls here makes a lot of sense, which is why I own it. But I'm trying to get that perfect, like buy more as it gets weaker this next quarter, because Q4 last year was very weak for the company. Like we're talking like 23% gross margins when this company normally does 40 or 30, not 40, or normally it is like say 30. So we're going to see this easy comp in Q4, but they're not going to report that until March. So we still have to get from now to March, right? The market should front run that at some point in the end of this year, but I mean, it still gives us 4 months to hopefully get an even better price on this Kohls play. But we'll see. So we are seeing one of the things that happened. So the gross margins held, which is nice because it's been in decline. I want to say for four quarters, because they're pushing so much inventory that they had to promote it. But the SGA line was under pressure this quarter. Part of that is because they had to staff the Sephora stores before they actually went live. 200 stores, not a small amount. I know it's here, just that I think is bottoming. And then, like I said, last year they tanked in Q4. They totally tanked the quarter. So when we get to Q4 this year, it's going to be very exciting. And we'll have to see if they actually pay down a revolver. I think that'll just be an easy way to get some more equity value over time. What else is there? Longer term, you can see Kohls has been kind of stuck at this or $19 billion for a while. This is a decade ago, $19 billion. This year they're probably not even going to do 17, right? So you have a material slowdown in sales. It's been stuck. It's actually been in decline for really since COVID. One of the things that's good about the company is that you can see here shares outstanding a decade ago 235. Shares outstanding as of the latest quarter was only 111. So they bought back so much of the company over the last decade, from to say 111, we'll call it 270. So they bought back more than half the company in the last decade. So that's very special. And again, that's with still so much property value on the books that they could just sales lease back and buy more of the company at a higher valuation, right? So, and the cheaper the share price gets, the more easier it is to argue actually doing a sales lease back to buy back your company with the proceeds from the sales lease back. But anyway, that's just something to think about in the back of your head. I think it showed that the dividend is also quite high for Kohls. Yeah, so 7.79%, still pretty high, and that's with the cut that they did during the COVID panic. So this is the activists getting involved. Anyway, they basically put in a bid for $64, and they were really pushing these guys to do the sales, basically unlock the property value of the books. Anyway, Kohls ended up doing a poison pill. I would say if you're interested, go to these guys' website, the McKellen one. You can see what it looks like there. Anyway, on page 10 of the McKellen document, that's where that $7.5 billion valuation of properties comes in. I kind of talked about how they basically want them to do sales leaseback at 14, 15 times EV to EBITDA and just buy back some shares, given their multiple debt was only at 4.8 times. I've already mentioned it's way cheaper now. Anyway, for some context to the 7.5 billion, according to the financials of Kohls, they have about 7.9 billion on the books still. Normal accounting treatment, so land doesn't depreciate, but the properties do, the buildings do. They slowly depreciate over whatever the estimated life is. So in our case, the buildings and improvements are over 5 to 40 years. They don't give the current accumulated depreciation for like each line item. They just have the aggregate at the bottom here. You can see that, roughly speaking, I would say if this was true, then there's going to be gains on the accounting side if they ever were to sell and do a sales leaseback. What else? From a margin of safety point of view, if this is true, this value backstop in terms of property value, then what you could do is take the current. So right now the market's only valuing Kohls at about 2.6 billion, and then you add the debt in, so 2.3, and then you subtract 200 million in cash, and you're about 4.7. That's your EV. So you can see the market's already pricing in less than what some fund thought the property value of Kohls would be, by a decent amount. Like we're talking more than $3 billion, or just around $3 billion, 2.8. So quite the disconnect to property value underlying, despite the fact the company is currently still putting up numbers even during this distress period, and still putting up cash flow. Well, not, I guess, not really in the current sense because of the capex is high, but it's putting up CFO anyway, so cash flow from operations. So we'll have to see what happens, but there is a type of value play here on the property side is what I'm trying to articulate. There's just more. So this is actually them basically saying how bad of a job the Kohls management was doing. Basically, here's your operating margin. They've basically said you're not maintaining your costs. You've gone from 11% to 6%. So there's a reason why the share price hasn't really done much. And a reason why it's cheap right now. I mean, they're only doing 4% this year, so it's very bad. Right? They're getting to go back up to 8%. But right, they haven't been able to. So this was worthwhile to read, I think, for people that are looking at it. And here they're attacking the turnover as well. They're saying their inventory is not managed as well, and under people such as Gap or TJX, and also saying they have unproductive mix. So basically, Sephora actually fixes this part anyway. But anyway, here's Thomas Kinsberg. So this is at page 25 of their document. This is one of the directors that they wanted to put in, and he actually became the CEO. I want to say, well, about a year later. Anyway, I just thought that was worth pointing out. Did actually get something out of it, even though Kohls did a poison pill. It basically shot this deal dead. So there was, I guess one of the bids was for $64 from Starboard back at KR Research. And that was just, I want to say March. When is this article? March 21st, 2022. So what is it, August? So yeah, 18 months ago, a year and a half ago, this thing was trading at 62. Now we're buying at 24. So you could argue that Kohls definitely should have took the deal in hindsight, but you don't know that. But it's worth bringing up that someone was willing to pay that at that point just 15 months ago, and now the market's trading down here again. So this is where the bid was coming in around this time. So anyway, It's all the way back down here, almost around where the COVID lows were. Not during the panic though. This thing got even cheaper during the very severe panic when people were worried about department stores because of the shutdowns, because all the spending shifted to e-commerce goods. But yeah, we're about in line with where we were during the panic of the great financial crisis. And here, you have to remember, back here, you had double the share count outstanding. So this company has bought back half the company. So this right here could be double the price, and that's the equivalent in terms of equity EV anyway. Just something to bring up in the back of your head, how cheap this really is in the perspective of this company. I talked about how Thomas Kingsbury became the CEO, and this is actually these guys that put him up on as a director to begin with. So they did get something out of it, even if Kohls ended up pulling the poison pill on them. Basically what the poison pill was, we don't really need to go into it, but basically it was like a dilutive effect. So if someone were to say they wanted to buy the company, or even tried to ask shareholders, the shareholders get an option to I think it was double their position at 50% of whatever the price was going to be. So totally screw over anybody who was trying to acquire them. So anyway, it was kind of interesting to play out because you hear about poison. Most people would hear about poison pills at the undergrad level, but it was interesting to see it actually in a real life scenario for billions of dollars. Anyway, this is why I'm excited between now and say when Q4 2023 reports, is because Q4 22 was so bad. What do I mean by so bad? Is because here you can see a decrease in gross margins of 1,000 basis points. So that's 10%. So normally, say if I made 35% on something, I'm now making 25% on something for the entire business for that quarter. That's how much they had to push inventory in Christmas last year. So I'm very excited to comp that because I think you can't do worse than that. So in rate of change terms, we're going to be approaching that inflection point, you can't do worse. At the same time, we're past the peak capex cycle of Sephora. So we have a couple catalysts that I'm excited about. And at the same time, you have a valuation backstop of the properties. That, like anything, you don't know how cheap it gets between now and then. So the game plan is to keep slowly adding, and then dream price would be under where my average is, so under 22. Ideally, be under 20, right? And these retail names do swing. People just trade them up and down like nothing. So anyway, that's just my thinking out loud. But this is just to show how bad last year was. So let's go through the call real quick. Here they are saying that their comparable sales were up 20% year over year for Sephora. So the reason why they are investing in Sephora is because Sephora is putting up some numbers. They're doing well. Here is the revolver comments. So basically, right, one of the things I don't like is that the debt's been going up because they've had to pay for this capex somehow, as well as keep the dividend where it is. And that has to come from somewhere. It's coming from the revolver. Now they're saying they're going to pay the revolver out this year. So that's something that I want to see. That would get me more excited. Even if the share price doesn't get cheaper, I might add if it does stay flat and the debt goes down. Anyway, I thought I was bringing that up, and they are going to be paying down $110 million in bonds that are due. And that is important too, because the revolver does have the higher interest rate because it is a floating rate revolver. What else is there? Gross margin. So they think they're going to get back to Q3 38% gross margin, which is nice. Their full year margin is only 36.5, but it does mean it's inflecting up finally, right? And it was down for so long, right? Just that Q2, they only put, what did they have? 23% gross margins. That's how bad it was. And at Christmas time last year, if we were about to comp. So next quarter, Q3 might not be that amazing, blah, blah, blah. It might just be mixed year over year. And then Q4, you get that nice, easy comp. August, so they're saying August is off to a good start. So that's why it's hard to judge when to get in, right? But we knew June and July were good. So it's interesting that they're saying August was okay, given how much retail's been selling off for all of August. Part of that is just because it rallied so much in July for no reason as well, I'd argue. Here they're saying the cross shop in Sephora 40 to 50%. So that's impressive. So the Sephora investment is working. They are able to cross sell into their other offerings at Kohls. So they're able to drive traffic in, and then they're able to convert the new people that are going in for Sephora stuff only into Kohls customers as well. So I really like that, and it shows that this strategy is working, and it might actually mean that same store sales don't decrease in 2024, but we'll see. Who knows? But that could be what it means for the first time in a very long time for this company. Anyway, here's shrink. So one of the things that's been happening, and the media's picked up on it, but it's been common for about 9 months now, is shrink's been up, theft's been up because the economy is actually weak, despite what people talk about on TV. It's been bad for a while on the good side, especially on the poor, lower income side. and so theft has increased. Here, Sephora is talking about how they're higher ticket items, so your average unit retail, average unit revenue is up. You can see, but then top it off, you have things like Tommy and Eddie and Nike, Under Armour that are also doing well. That drives up tickets. So the national brands instead of private brands. So private brands are generally cheaper, less well known. They're usually like I said, like the great value. Well, people know that one because Walmart's special. But like most, like I couldn't name a Kohls private label brand, right? But I can name the national brands, which would be Nike and Under Armour. So those things are higher ticket items. That's what I'm trying to say. Here, they're actually talking about how national brands are outperforming private brands, and that's been weird because, say, like even like a Walmart was seeing better penetration in private label. Walgreens were seeing better penetration in private label. Grocery stores were seeing greater penetration of private label brands, but we're not seeing that. So that's very interesting. It tells me that the Kohls private label brands are weak, or at least that's what I argue. What else is there? This one I thought was kind of interesting. So he's kind of like saying things that he's a newer CEO. He just came in. Well, he's 70 years old, but he's newer for Kohls. He just came in last year. He's basically saying there's a lot of easy things that he can do. He just thinks that they don't have the optimal assortment lined up. So he thinks it's very easy for them to get that as they go into next year as well. So having more of the right things at the right times, at the right locations. So I thought that was worth bringing up because that means that he's not just saying everything's awesome, right? He's making changes. Here he's basically saying home decor is the higher margin business. So one of the things they're also trying to do is as you exit the Sephora place, they're trying to put their higher margin businesses near that higher traffic area, if that makes sense. So that's also something to keep on the back of your head as we go to try to get higher margin per unit sold and in terms of sales mix, which Sephora is already helping by itself. But these things, they can try to cross-sell special things next to that or adjacent to that Sephora offering where it has the highest traffic, or higher traffic rather. Here's some other things they're doing for SGA. So SGA was high this quarter, and I didn't like that. Well, one of the reasons why is because they had to staff it up before they went live with all the stores and train. But here you have the SGA still going up, but not as much as it has been. A part of that is self-checkout in Q3, expense related to it for 250 stores. So they're trying to combat the wage pressure that they've been seeing and that more stores have seen. Like we've already seen a lot of stores go self-checkout, right? I think that's like to continue. And then here's a CEO saying that gives us confidence that we'll have Sephora in all of our stores. So that's their game plan. They've already done quite a lot of the stores, but I thought that was worth bringing up to you guys. It's definitely a fun one. You have a cheap retailer, but at the same time, you have a property backstop with the Sephora investments. Finally, we're already past the peak investment cycle of that, so we should start seeing that return on investment over time. So anyway, it's an interesting time. I'm hoping that it gets a little bit cheaper in the short run to really get more and more excited on this one, but I wanted to get the video out given today's, it's been selling off with retail. I thought it was an interesting one. It's one of the better retail ones, I think, in the longer term because of the Sephora catalyst investment and with the property value backstop. If that was required, if things got really bad for Kohls, you could unlock a lot of property value and buy back a lot of the company. Anyway, that's Kohls, and have a great rest of your weekend.